Mr. Anish Dey, Global Sector Head for Power and Utilities at KPMG, based in India, and Mr. Oliver Phillips, Associate Director of Sustainable Finance for Africa and the Middle East at Standard Chartered Bank. Thank you very much, gentlemen, for joining us today. And we're going to be focusing today on the question of sustainable finance, mainstreaming sustainable finance towards net zero. So we'll start the program as usual by asking each of you to select one of the bulletin headlines from our list. If we can have that up on the screen, thank you. Anish, I'll start with you. Did any of those catch your attention?
Yeah, Mira, just run through them. Yeah, possibly, number 4, investors want to increase blended finance in climate fight. Keen to understand how that will play out in reality. And yeah, we can talk more about that. And this, number 6, also Germany to pump 56 billion into climate fund, because how the deployment is going to happen is quite interesting, and we can talk about it more.
Okay, well, let's talk a little bit about the blended finance, their public-private sort of cooperation, I'm assuming is what, and I did read that article this morning. I mean, are we seeing, let me start by asking you, are we seeing enough public-private cooperation on financing towards climate mitigation, and if not, why not?
So the short answer is that we haven't yet seen enough public-private collaboration, cooperation. There's been some amount of money flowing in from public funds through public channels like the development financial institutions, but that's inadequate. We know that all those targets have been missed. And really speaking, if we have to really scale this up, then public and private finance need to come together and really put the money where it is needed. And a lot of the money will be needed in the developing world, because that's where global growth is happening. So they have to decarbonize on the move. While they're growing, they have also got to simultaneously decarbonize. And as Oliver will mention, I'm sure that the risk profiles in those countries are quite different from the developed world. So this is where you need the public sector and the private sector to come in together, create the right instruments, so that risk can be taken by private finance and channelized to those markets.
Yeah, I mean, and let's talk a bit about that. Oliver, welcome again. Before I ask you to pick an article, let me go to you on that point of public-private cooperation, or how much we need of each. I mean, COP26, which of course finished last month and ended, one of the main sticking points was finance, and one of the main criticisms of the developed world towards them was, you have not met your $100 billion a year commitment yet, and we need even more than that. And sort of what commitment are you prepared to do? Because at the end of the day, if there's no financing available for the developing countries, they're not going to be able to meet their NDCs. So it's sort of a chicken and egg, Oliver. And did you feel that after COP26 we had any rejuvenation towards what's needed to be done for developing countries?
Well, thank you, Diana, and it's great to be back speaking with Gulf Intelligence and talking to you and Anish today. Look, I think this is for me the key thing, and for Standard Chartered, given our footprint is emerging markets, it's developing countries, that those challenges that Anish just mentioned around both growth and sustainability are front and center for, and therefore front and center for us. Look, I think that there was definitely a positive direction at COP. I think the right things were said. The devil is always in the details, though. And what we need to see is really whether actually the good sentiment is going to translate into concrete actions. And this is where I think that actually it's important for our role as the private sector to really mobilize and start pushing towards this. And I think once we have that kind of concrete private sector sort of mobilization, a real effort and thought in terms of going and actually driving this finance in those developing markets, we do need to be bringing in the public sector as well. But I think the challenge is making sure that you get that sort of movement in that right direction going to start off with. And I think the private sector has a role to play there, to be the agitator for it. Don't wait for the public sector, for the development finance institutions and the likes to kind of say, okay, well, we want to do this. Actually go to them and say, look, we need your help doing X, Y, and Z. These are the transactions we're looking at. These are the projects that we're trying to support. This is what we need from you. And I think once we start having that conversation, we're going to see a much more concrete action. I firmly believe blended finance is going to be a key part of the solution. It's something that at Standard Chartered we've done a lot of, and I think that's going to be very important to bring more of.
Okay, and I mean, are private institutions such as your banks, both of you, are they getting better structure towards the money flows going in the right direction, or is there still that sort of inherent bias towards, you know, carbon intensive investments, which have been there for decades and are still, you know, very good sort of bottom line targets? So, you know, how are institutions like yours approaching this target of sort of, I suppose, of trying to get a double bottom line, you know, for sustainability and profitability?
I'll let Oliver take that first. Yes, go ahead,
Okay,
Oliver.
Anish, go ahead. Yeah.
Okay. Thanks,
Oliver,
Anish.
Oliver.
Yeah, well, look, so Standard Chartered about a month, I think it's a month ago now, actually released our detailed roadmap on how we as a bank are going to get to net zero by 2050. And this is really looking at how are we going to actually decarbonize our financed emissions to our, well, all of our lending book, but you know, first of all, tackling our 8 most intensive sectors. And we've set kind of interim targets now for 2030 for power generation, for oil and gas, and for the metals and mining sector. And the other 8 we're going to release, so the other 5 of those 8 we're going to come out with in the next couple of years. But those are obviously where the emissions are. And I think there is a real push within the banking sector to do that, to tackle that. We've seen, you know, First Abu Dhabi Bank as the first regional bank in the Middle East to commit to net zero. I'm sure many others will follow suit very shortly. And we're seeing other banks across the world do that. Now, again, I said it at the start, the devil's in the details. We actually committed to net zero and released it in March, but we made no fanfare because we were still working out how we were going to do it. It was only a month ago, just before COP, that we actually started to put out really concrete information around it and around the strategy and what we're going to do. And part of that is committing to mobilize $300 billion by 2030 for green and transition finance. And the transition finance bit is really key because that's what developing markets need. They don't just need the solar, that's great. We need lots of that, don't get me wrong, but we need to work out how do we decarbonize everything in between, manufacturing, the existing energy supply, transport, all of these things need to be looked at from a transition point of view.
And of course, that argument, Oliver, has been made, you know, during COP26 and afterwards in the conversations we've had with the industries. You know, finally, people are sort of waking up to the fact that we cannot, you know, just overnight obviously go into green 100%, and we have to transition slowly and obviously finance that transition, which obviously has been lacking funds, Anish, for many years, you know, in terms of the funding and investment going into conventional, let's say, energy, for example. So how institutions like yours managing that from your client point of view? I mean, what reaction are you getting from your usual client oil and gas companies who want funds to transition? Are they receptive to that? Are they you know, calling for more of that? What's the feedback you're getting from those who you would usually engage with?
Right. So we are not a bank, of course. We are a consulting organization, and I'll tell you that perspective. And Oliver has indeed covered the banking perspective. But if I just had to step back and look at it, how this is playing out, you know, high carbon equates to high risk for anybody who's putting in money, and that comes in 2 ways. One is that you know, you have a risk of to the portfolio directly because, you know, obsolescence can happen, you know, or you can be under, you know, carbon taxes or even stakeholder pressure, and hence that puts the portfolio to risk. And the second part is that there is a reputational risk which organizations are becoming very careful about. So even if your, you know, bottom line targets are met, your valuation can go down, your standing in the market can go down, and that's not good for you. Eventually your cost of funds go up, or it may not be possible also to fund many of the things. So I think across the world, from the supply side of finance, we are seeing a great aversion to high carbon projects. Now, the transition finance is still a very, very important theme because we can't make that change overnight. But this is where gradation will happen, you know, something which has an alternative which is available, but it's only just that the transition will be demanding in terms of money, that money is available. So I think people will be, for example, if you take coal, okay, you can't build another coal-fired power plant at scale at all anywhere in the world, really, unless it's somebody with national money puts it that. And even national money is difficult to find for such things. There's too much of opposition. Oil and gas come in between, because we know that we have to have a sunset date for that. That change cannot be immediate, but that change has to be working to a plan. The challenge is that even a tenable or a practical plan is going to find difficulty for the reasons which I mentioned. There's a fair amount of stakeholder opposition to that, irrespective of whether it's a practical or sensible plan or not. And eventually reputations are there. And I think that's a real risk, because if that doesn't work well, then we're going to see commodity prices spiral out of control, which has already started happening. And now I'm really scared about what is going to happen. And this is where I think the national oil companies and others will have a key role to play, because the Shells and the BPs of the world are going to be under stakeholder pressure. Even the American companies are going to be under stakeholder pressure. So the national oil companies will have to step in. It's good for them, it's good for the world to kind of make sure that happens. I'm not so confident about adequate amount of transition finance being available to the national the IOCs at all. And then there's a third part, which is on the clean technologies. Now, even to scale that up, there's a significant amount of risk capital which has to be put in, because not all those technologies are quite where they have to be. So I think that is also something which we need to watch out carefully. That how does finance find comfort that that's worth investing in?
Yeah, and on the private sector side, that's obviously more risky. You mentioned the Germany article, which is Germany putting more towards it's pumping 50 billion euros into its climate fund. I mean, Europe, Oliver, has just been leading the way on all fronts, hasn't it? Really, whether it's by setting up funds in country or across the continent, or by actually putting in legislation and policy to start controlling emissions. How soon do you think we're going? And from a financing point of view, does that make that part of the world more attractive for private investors and for putting funds into those? Is it more believable? Do they have more trust that they're going to continue on this path?
I think in terms of attractiveness of Europe, and I think I'd include kind of North America in that as well. The attractiveness is there because there is attractiveness in terms of financing that, because that's where a lot of the investment capital sits. It's where a lot of the companies that they're kind of constantly covering are based as well. And I think while there is a degree of kind of comfort that there is greater sort of standardization and greater adoption of best practices in Europe and North America, I think investors do take comfort in the other parts of the world. And even when you look at something like Africa, earlier in the year, we launched a transaction, a sustainability bond issuance for Ecobank Group, which is a Togo headquartered Pan-African banking group. And we were able to upsize that transaction by $50 million, as well as moving the price significantly tighter over the course of that. Now, that shows that investors do have confidence in funding sustainability in countries like that. You look in the Middle East, in Dubai, Abu Dhabi, and Saudi Arabia, and actually Oman as well recently, we've seen some large kind of renewable infrastructure projects happening. Clearly, there is interest in capital, and there's not just banks that are big on the ground like Standard Chartered. We're seeing banks from Japan and from kind of the rest of Europe as well coming in and participating in these transactions. So I think there is definitely that appetite to go outside of Europe, where obviously, as you said, has been leading the way, but we do need to see more of it. And I think that's the key thing. There needs to be a real concrete sort of looking outwards sort of approach from particularly from Europe.
In fact, I would suspect that some of that fund is earmarked for investments outside Germany. So as a part of the multilateral support, that fund might be going, and part of that might be going there.
But I mean, outside Germany, within Europe, or beyond the continent? Even
beyond Europe. I think as a part of Germany's global obligations, that fund might be supporting that. I haven't read the article, but it'll be interesting to see that.
Yeah. Anish, do you feel that the capital markets, generally speaking, are factoring in to the risk of climate catastrophe, if you like, or climate risks, are they factoring in that risk into their sort of investments into other securities, if you like? So how much are capital markets factoring in the damage that if we don't do something to sort of get stricter on finance for these initiatives, that in fact that's going to start to impact their other securities? Is that thinking in the box with your clients, for example?
It's in the frame, it's in the box, but I don't think there's been concrete progress on how to translate this into the lending practices, principles, or others, because this is a fairly global risk, right? It's not a project specific or investment specific risk. So you're talking about the basis of the business itself gets questioned when you have such large risks playing out and you can't do it. I don't think people have found a practical way to deal with it. What has happened is that for specific investments, the levels of climate diligence is going up very, very significantly. So whether that investment is climate proof from a physical standpoint, from a portfolio standpoint, whether obsolescence of the portfolio, all of those are getting much more attention, and also the broader ESG parameters to see that really is this ESG compliant. So what used to be a tick in the box till recently actually has become much more serious business.
Anish, do you think that this year we've had an energy crisis, i.e., we've had energy prices rising, particularly gas prices, and that's pushed oil prices up until, putting aside what happened last week. But generally speaking, a shortage and energy crunch, big consumers like India, obviously, and China will feel the impact of that. Is that sort of factoring in at all into? Has that changed the perception, if you like, of consultancy or finance in terms of what to fund next? Are we focusing too much on ESG, or should we be taking a step back and recommitting funds to dependable energy, if you like, putting aside coal, but oil and gas?
So I think there are two parts to it. One is that what do those not the financiers, but the investors, developers want? And I think we are going to see sustained pressure on the European, oil companies, that irrespective of what happens on the prices, you really will not scale up investments. Okay, so that if that demand is limited, irrespective of what happens on the prices of commodity, the supply also will not be of relevance. So I think that we will change the attitude of demand. The world of finance will change the attitude of demand in a very significant way. And if you come to the Middle Eastern region, where the national oil companies dominate and they have the cash, I think we are going to see scale up of investments, because for everybody is good if oil prices go beyond a certain level, or gas prices stay sustained beyond a certain level, then honestly, it's not good for anyone. And the people who have the maximum flexibility are the OPEC countries, and they will possibly see that that level, balance that level out so that it doesn't go out of hand. That's my take on it.
Oliver, just let's talk a little bit about COVID. I know that we've addressed it in a few of our discussions. And of course, we have a new impetus on the news front there in the last week. But how much is that factoring in to pricing processes and to financing decisions by banks towards these initiatives, even medium term? Is that at all factoring in or not?
I think the really interesting thing that came out of COVID is that when we looked at what was happening in sustainable finance beforehand, there was a big focus on the E. Now I separate the G out of ES and G because you can't really finance the G. The G is sort of something that should be embedded across everything, but you can finance the E and you can finance the S. And COVID has actually led to a pivot. We've seen less of a focus on just the E and more of this kind of recognition of the fact you need to bring in the social aspect as well, and particularly ensuring that there's adequate social infrastructure in place is going to be crucial. Now we look at something like like what's happening in Africa, what's happening globally with the Omicron variant at the moment. unless you can lead you can sort of support, equitable vaccine access for everyone, you're going to always have kind of these risks of recurring waves. And that's the sort of thing where making sure you have this social element comes in really kind of importantly. Now, I think also this social piece goes right back to what we're saying at the start, which is, for some countries let's take, I don't know, Nigeria, which is obviously very kind of dependent on oil and gas. They've got a national oil company, and Anisha's just been talking about those and the roles that they play. It's not just possible to say, okay, well, I'm turning off the fossil fuel. You also do need to make sure that you're looking at that social impact side. And that's where looking at something like, for example, gas as a bridge fuel, as a transition fuel, is really important. And, I think your comment earlier around, the role of fossil fuels, we are, until we have battery technology or kind of things like hydrogen in a state that they're not at today, gas is still going to need to make up some portion of the energy mix as the lowest carbon fossil fuel, but also as something that can work very well as a base fuel and can kind of meet that gap and meet that shortfall if it happens to emerge.
Anish, just to go on to just to ask you about the topic of okay, I've got our poll up here. It's put up our survey question today, which goes back to I suppose the first question we were talking about at the beginning, which was the COP26, the commitment to double adaptation finance to help the lowest income countries improve climate resilience. The COP commitment there to 40 billion in the next 5 years is enough. I suppose that's a statement, and we want to ask our audience whether they think that is sufficient. Is it sufficient? That's option number one. We're on the right track, but more is needed, or we're nowhere close to meeting that challenge, that we need much more than $40 billion in the next 5 years to even get close to helping those developing countries adapt to the changes that they need to make to meet those commitments. Anish, let me ask you, how would you vote on that?
I would vote for the third option, nowhere close to meeting the challenge. Because we're already seeing the effects of climate change all across, and then we have not hardened the systems anywhere close to what they need to be. This requires for hardening your power systems, your transport infrastructure, your industrial infrastructure, everything. And 40 billion is peanuts.
And I mean, what will it take to make that shift? I mean, I have a figure here, which is, that there's some institutions are actually advocating for $1 trillion for climate finance, mobilizing $1 trillion a year, not 100 billion by the private sector. I mean, how are we going to make that sort of shift that's required?
So it's a difficult question, because we are at a point where finding that kind of money from anywhere is going to be very, very difficult. And we haven't even reached the 100 billion which was committed. We have always been pushing out the deadlines. But the fact that kind of money is necessary is without question. I would say that in terms of the balance of convenience on that would like closer to $1 trillion rather than the billions. So maybe Oliver would have a view on how we can find that kind of money. But I can talk about the need. The need is on very high.
Yeah, I mean, Oliver, what is the next investment paradigm, if you like, over the next 5 years? I mean, what does it look like ideally?
I think ideally over the next couple of years, we need to see a continuation of what's been happening already with the sort of the most emitting things like coal. I mean, as Anish mentioned earlier, it's almost impossible to finance coal now, and I think that's a really good thing. But we do need to see that we need to see this kind of the transition piece pick up, and this is the bit that I think we're still going to struggle with. Even if we fund all the green projects in the world, if we don't look at what we're doing in terms of transition and transitioning the existing stuff, and also the stuff that at the moment that we don't have the technology to fully decarbonize, for example, steel production, which is obviously so crucial to global infrastructure, we're never going to get anywhere near to meeting the Paris Agreement and restricting global warming to less than 1.5 degrees C. The thing that I'm really excited about in terms of how it's going to play a role in this is carbon markets. And that's the next kind of area of sustainable finance that I really want to see pick up, and I think is going to pick up. And Standard Chartered has been sort of working very closely on this through things like the Task Force on Scaling Voluntary Carbon Markets, or Climate Impact X that we just launched in Singapore with some partners like Temasek.
Yeah, and I mean, I was going to get onto that carbon markets and the whole offsets argument. And one challenge there has been, of course, transparency. And Mr. Mark Carney, after he left the Bank of England, set up this whole group where they're trying to sort of work very hard on that particular initiative. And obviously, it's a big challenge. The transparency globally on carbon credits, offsets. Shenanigans and wheelings and dealings happening already, probably under the table on that front. So exciting, you say, an exciting field to take off. But will we see progress given the transparency challenges there and cooperation that's needed?
I think there you need to actually start off with, first of all, what does it mean to be net zero? Because offsetting is irrelevant without a proper net zero strategy. And net zero is not just offsetting everything. Net zero is reducing your absolute emissions to the greatest amount possible, and then offsetting that unavoidable bit that you cannot actually reduce. Now, once you have a proper strategy that incorporates offsetting into a real decarbonisation pathway, then you can look at the quality of offsets. And that's what the TSVCM, Task Force on Scaling Voluntary Carbon Markets, that Mark Carney sort of initiated and our group CEO, Bill Winters, was chairing, and has now moved into its sort of implementation phase, which Standard Chartered also has representation on the advisory board for. That's what that's really looking to do. Create standards, set good practices, make sure we're looking at things like, verification that the right projects are being financed. We're not doing things like clean coal, which used to be available under the UN's clean development mechanism, and to really kind of drive harmonization of those standards, accountability for those standards, and to make sure that the market does know what good offsetting looks like, and that the market can therefore reward good offsetting and stay away from bad offsetting.
Anish, I mean, just looking at India as an economy with a lot of manufacturing, a lot of heavy industry, obviously the volume of that, and from an emissions point of view, where do you see a country, a big consumer like that, participating in the whole carbon credit offsetting markets, and can it?
Okay. So I think the intent to invest in low carbon resources by heavy industries is very high. I'm not saying that they got there, but the intent is very clear, especially the large organizations. We have our annual event coming up, and we are hearing, the Tata Steel MD, managing director, who's also the president of the Confederation of Indian Industry, kind of talking about it, that we have to make that transition. The question is, it's a fairly expensive transition, and hence, if you're doing something, the carbon markets become fairly central to some of that. So I agree with Oliver that having the right market and the right attributes in that market is going to be absolutely critical. I'll just emphasize on one more thing, which is data. Because the quality of the attributes depends on is as good as the reporting and what you do with that. And this is where we need to bring a lot of technology in and have not standards, but good practices at least, to say that, okay, this is the quality of reporting that we will believe if it's backed by these kinds of credible sources. So I would say that there is appetite, but there is not clarity on the way that has to be done, both in terms of core technology as well as the information technology, which will help report it in the right manner. There's a lot of work that all of us as a community needs to do, and I think that's where the initiative by Mark Carney and where your group CEO is involved. I think that's very critical to get down to the next level of detail and saying, what does good look like? That is very, very important to demonstrate.
Oliver,
but the intent is a problem.
Yeah. Oliver, I'll go to you just for the last word. We've actually already run out of time. And to ask you, is the financial sector being strict enough with its conditions to making finance available? There's been criticisms that it's not actually, and it's still far too easy to get finance for what you like. So are we seeing standards being strict enough by those institutions who are looking to fund initiatives across the board, across economies?
I think look, there are two bits to this. First is managing the environmental and social risks of any project, whether it's a good project or arbitrarily or argument. Okay, you might make an argument for it to be viewed as less good, but that bit in terms of managing the risks, I think the finance sector has done a lot of work towards and has really done a good job in putting things in place like the Equator Principles for project financing that do a great job there. On the other side, I think this comes back down to this balance of how do you drive both growth and sustainability and kind of transitioning towards net zero. And it is a journey. It is not something that's going to happen on day one. One of the things we think about at Standard Chartered is if we turn off the taps and stop funding some of these projects, then it doesn't mean that no one else is going to do that. Other banks may step in, local banks may step in, and they might not have the same kind of focus on doing these projects in the right way, driving, pushing these clients to be as sustainable as they can within the constraints of what's available to them right now, and making sure that those risk management practices are still really kind of well upheld. So there is a role for banks to play in kind of continuing to support some of these projects and transitioning out, but the lines in the sand do need to be drawn. Things like coal, we've already seen that, and I'm sure that situation is going to emerge and kind of change over the coming years, and different sort of areas are going to come under focus, and there's going to be more stringent kind of restrictions on what can and cannot be done.
Oh, I don't know if that's a cat or a baby, but all right, we'll run out of time already. Oliver Phillips from Standard Chartered and Anish Dave from KPMG. Thank you very much, gentlemen, for joining us on the program, and enjoy the remainder of the week. Thank you for joining us, everybody.
Thank you. Thank you for having us. Thank you.
Thank you.